Hello and welcome to Everyfin's first video feature. Today we're going to talk about equity-linked saving schemes, which are mutual funds which allow the investors to benefit from tax exemption under the ATC of Income Tax Act. So every investor is eligible for about 1.5 lakhs in tax exemption if they invest in these funds and stay invested for a period of about 3 years. There are about 40 different funds which are available to the investors to choose from. So those are just the open-ended funds from the different fund houses. For today, we will collect data from Valueresearchonline, which is a website which has collected all the returns and risk profile of these different funds. We will also be looking at so these are just the open-ended funds, but we will also be looking at the closed-ended funds, which are not available for investors anymore, but they sort of give us some additional data points we can work with on risk and returns. I've already consolidated the data for the different funds, so you can see it on this Excel that I've got data for. I've got year-wise returns for these different funds, which are open-ended and closed-ended. Quarter-wise returns are also available. Recent returns, which are 1 month, 1 week, 6-month returns. Also, I've also got the fund performance tab is just the open-ended funds, which are, like I said, about 40 of them, and their returns over the period of last 1, 3, 5, 10 years, as well as returns against the benchmark. So this is the data we'll be using for today. We'll need some additional data, but I'll be consolidating them later on. So what we'll do is we'll use Python in order to work through this data, to calculate some of the risk measures like semi-deviation or value at risk. But we'll also look at risk return measures like Sharpe ratio as well as alpha calculation in order to sort of try and filter out which are the best funds from this to choose from based on their historic return profile. And finally, we'll do something called a principal components analysis, which will help us find how similar some of these shortlisted funds are to each other, so that we can just, rather than picking funds that are too similar to each other, we will just pick funds that are distinct or different from each other. So let's get started. Again, if you're not too familiar with Python, that's all right. We'll focus on the result. But if you are familiar with Python, you can just pause the video to check the code out. Right, we'll just load the libraries, and then we'll load the data from the Excel into the Python environment, and that's what we're doing here. So you can see that I've got 6 different tabs on the Excel spreadsheet, and I've loaded them into 6 different pandas data frames. Let's quickly test the data. So let's check if we're getting the data from the Excel, which we are. So this is what I'm doing here, is getting the year-wise return for this particular fund, which is on the Excel. So obviously you can see that it's picking up the return data. It's not in this is 53% return, so every time we do calculation we'll have to divide it by 100, but that's a small problem. We'll also be using a file called Risk Toolkit, which I've developed for this purpose, which sort of gets us it's got functions which do basic calculations which we need, so skewness, kurtosis, semi-deviation, value at risk, etc. What I want to do is just make sure that it works, and it does. So what this is doing is it's calculating the wealth index. So what I've done is, let's say I've invested 1,000 rupees on this fund in 2013, and what this is doing is it's calculating how much wealth I would have in each of the years. So in the first year, the fund recorded 53% returns, and obviously my wealth would have gone up to 1,533 rupees. All works. Now, Sharpe ratio is excess return by excess volatility. What it does is it calculates what's the unit excess return for unit excess volatility or volatility that the fund has taken on. A higher Sharpe ratio is better, a positive Sharpe ratio is better, but funds can have negative Sharpe ratio if they have not delivered as much return as the risk-free rate, and you will see that. So let's calculate Sharpe ratio on the basis of year-wise returns. So we've done that. So we can see that some of the funds, that these are the funds that have returned with the highest Sharpe ratio. So The SBI's long-term fund Series 5 has a Sharpe ratio significantly higher than the others. And this is because I looked into the data. This is because this fund was only launched in 2018. So they did not suffer as much drawdowns as some of the other funds did in the earlier years. Quantax Plan, interesting fund, has got a Sharpe ratio of 0.4, which is the highest, which is one of the highest compared to the others. We'll be talking about this fund several times. Let's look at quarter. So this is Sharpe ratio based on yearly returns, and now we look at Sharpe ratio based on quarterly returns. And now immediately you can see that the SBA long-term fund Series 5 is not on this list, simply because they haven't got the rich history of data. But some of the other funds come up: Canara Robeco, BOI AXA Midcap Fund. These are, again, interesting funds which we'll be referring to later on. So these are some of the good funds based on Sharpe ratio calculation. What we do next is we'll do a quick plot to see how Sharpe ratios compare based on yearly returns as well as quarterly returns. Anything that's negative, which is in this zone, has returned negative Sharpe ratio both on yearly and quarterly, these are terrible funds. Anything that's below this line has negative Sharpe ratio on a quarterly basis. And anything in this quadrant here has returned positive Sharpe ratio on both yearly and quarterly returns. So we can see that a vast majority of the funds have returned negative in the quarterly returns, and this is primarily because of the significant drawdown that a lot of funds witnessed in January, in the January to March quarter of last year. But there are some funds which have which have delivered good Sharpe ratio, and some of them I've mentioned already, but we'll talk about them again. Let's look at the frequency distribution to see on the basis of their yearly returns. We can see that there's a wide range starting from about minus 0.3 to 0.4, and there are a vast majority of the funds are concentrated in this. It's not really a bell curve, but a vast majority of them are concentrated in this particular area. But we are most interested in the funds that are performing well. So anything over 0.3, and this line of code will just fetch those funds. So you can see some of those funds that we've already seen. So SBI's long-term fund, Quantax Plan, Canara Robeco. So all of the funds that we've already seen are on this list. Let's look at drawdown. Drawdown is the difference between the peak value the portfolio achieved and the trough. So let's say my portfolio value is 130 and then it goes down to 110. So that drawdown would be 20 rupees, or if you can calculate it in percentage, then it would roughly be about 18-19%. Drawdown is an interesting measure of volatility. So what is the reduction in the value of the portfolio, and here we'll compute it on the basis of yearly as well as quarterly data, and this is in percentage basis. So what this tells you is if you'd held this fund, then the maximum drawdown, the maximum reduction in value your portfolio would have seen is about 38% from the very top to the very bottom. This is again a volatility or risk measure. So let's take a look at this from a quarterly data as well, so you can see most of the funds are Sundaram long-term funds. These funds keep coming up over and over several times. They don't seem to have delivered as good historical returns. But the Quantax Plan fund, like I said to you already, is an interesting fund which we'll be talking about in a little bit. Let's do a plot. And so what we're plotting here is the maximum drawdown based on yearly returns against the maximum drawdown on quarterly returns. And what we're seeing here is that quarterly returns are much more, you see a lot more reduction in value when you look at quarterly returns compared to yearly returns. And what this tells you is that over a long period of time, these violent reductions in value get smoothed out. And this is why I keep saying that equities and mutual funds should be held for the long term, because then your overall drawdown or your reduction in portfolio value will be significantly lowered. But some of the funds have witnessed no drawdowns at all, and these could well be the most recently launched funds. But you should expect, and this is what this chart tells you should expect, that if you're invested, then you should expect a 30% reduction in portfolio value over a period of time. And then we'll calculate what that is as well. So that was based on, this is based on yearly drawdowns. Let's look at the frequency distribution chart. So as I told you, about 25 different funds did not witness any drawdown, which is great. but you can see the drawdown profile for the rest of the funds. They're a bit all over the place. Um, we are especially interested in those funds which are past this particular point, which is 25% drawdown. These are, these funds suffer the worst possible drawdown. Let's look at what they are. So the Sundaram funds keep coming up here again. So I did tell you about them. You warned. But the Quantax plan again comes up as the top. It seems to have recorded 38% in drawdown, and we'll look at the data as to why that is, or what is a peculiarity about that fund. We're doing the same on quarterly drawdown. So here you can see that, when we looked at it from a yearly perspective, you sort of saw a lot of funds that did not see any drawdown at all. But here now you can see that 0% isn't there, because like I said, the quarter from January to March of last year, most of the funds witnessed significant reduction in value, and you can see that if you just take the value, the quarterly returns value. Let's look at these funds here. So these funds are the ones that witness the least drawdown. Let's look at which ones they are. So you can see BOI AXA Tax Advantage Fund has come up. So this is again one of the funds which we saw had a higher Sharpe ratio earlier. So interesting fund. Which I mean, if you think about it, the market's reduced in value by about 35-40% in March of last year, and to think that this fund registered only about 19% drawdown is a good deal better than the market. Then let's look at semi-deviation. Semi-deviation is a measure of downside volatility. So what is volatility? Volatility is what is the distribution of returns around the mean. Yeah, we're not really interested in upside volatility. So if your fund performs on an average, it delivers 10% return and has suddenly registers a 20% gain on one day, we're not really interested in that, because that's great, we'll take it. But if the fund performs 10% and on an average performs 10% and records negative 20% in return, then that's downside volatility, and we're quite worried about that. So that's what this does. It calculates the volatility when the returns are negative. So we do the same. We use the yearly data as well as the quarterly data to calculate it, and we can see the Quantax plan comes up again. So we will investigate the Quantax plan here, but some of the other funds which have higher downside volatility are on that list, and these are based on quarterly data. Again, they only serve. So this calculation only serves the purpose of looking at funds which are risky. We don't look at returns at all. We just look at what is the volatility of these funds. So we again, as equity investors, we should not be shying away from risk, but at the same time, we have to make sure that the fund returns commensurate to the level of risk it takes up. So let's again plot it very quickly. Again, it's a very similar plot. What you see is the downside volatility is zero for some of the funds based on yearly returns, but it's not zero for them based on quarterly returns, but they're a bit all over the place. But you should expect about 6 to 10% in downside volatility when you invest in these funds. So quarterly returns. Let's just look at the funds which have on this. So let's look at the funds which have more than 10% semi-deviation in yearly returns, and about 6%, maybe more than 6% in quarterly returns. So let's just look at the culprits really, and you can see some of these names did come up before. So the Quantax fund comes up, and I think the AB Aditya Birla Sun Life Fund 96 also came up. But interesting measure of risk, that's all. Let's investigate the Quantax Plan Fund, because this is an interesting fund. So what I'm doing here is I'm computing how my wealth invested of ₹1,000 in this plan grew over the last decade. So this fund came into being in 2010, I think. So let's look at, if you'd invested in that fund, what really happened. And you can see that the fund witnessed a significant drawdown here. This is a 38% reduction in value, which we kept seeing in the previous analysis. And then it just went one way, which was primarily up. And you can see the returns data here. And you can see that, the first year of its existence was a 38% reduction in value. And then it pretty much went straight up. So that's why this fund has a good Sharpe ratio, because, the returns are consistently positive. But because of the single drawdown, it also keeps coming up as the worst offender in terms of volatility as well as drawdown numbers. So it's important to consider the underlying returns profile data when looking at some of these risk measures, and they sort of give you a view of how the performances of the fund has really been. I think this is the final risk measure, which is value at risk. Value at risk is the minimum amount of loss you should expect when you invest in one of these funds and stay invested for a certain period of time. So we take level 5, which is 5%. What is the minimum loss that you should expect 5% of the time? So that means that 5% would be over a period of 20 years, a 5% would be 1 year. And what this value at risk tells you is what is the percentage loss you should expect that it's over any given 1 year period over that 20 years. So let's do that with yearly data. The minimum loss you should expect to get from this particular fund over any 1 year period is about 40%. I mean, you will obviously make money over the vast majority of the time, but this is the 5% to the left of the curve that you should expect. It's a bit of a complicated interpretation. I struggle with it myself, but the idea is the funds with the highest VAR, value at risk, are the riskiest funds, and you can see most of them are Sundaram funds, and I think I spoke about them earlier as well. Again, we did that with yearly data. This is quarterly data, and the interpretation is if you're invested over 5 quarters, then the 5% at 5% minimum loss you should expect is about 34% over a single quarter. Again, from the names, you can see the Sundaram funds. So if I were you, I would just stay out of these funds. Let's look at alpha. This is a return measure. So what is alpha? So every fund has a benchmark, right? So they say that our performance should be measured against this particular benchmark. It could be Nifty 50, Sensex 30, whatever, and alpha is the difference between the return on the mutual fund minus the return on the benchmark. A positive alpha means the fund manager has selected good stocks from the benchmark, and he's recorded better performance than the benchmark. So we have data for 1, 3, and 5 years return, and the benchmark return for each of these funds. What we're going to do is we're going to compare the alpha. So that's what we've done. If you go to the right, if you go to the right, you can see these are the 1 year, 3 year, and 5 year alpha. Let's just visualize it to make it easy for us. So on the x-axis, we have 1 year return alpha, and the y-axis, we have 3 year returns alpha. And anything on this quadrant has recorded positive 1 year alpha and positive 3 year alpha. So we likey. And anything on this is both negative and negative 1 year and 3 year return alpha, which we don't like. So obviously, I'm also interested in finding out what these funds are. So let's get the data. The entire data is here. Let's go in and plot it, which I've already done. And that's what this plot looks like. So Quantax Plan Fund, which I showed you earlier, has recorded both, for the last 3 years, has recorded positive alpha for both 1 year returns and 3 year returns. And the other two funds are Mirai and Canada. So these 3 are interesting funds, which you will take a look at. And you have a whole host of other funds which have not delivered alpha over the last 1 year, nor the last 3 years, and we're not really interested in them. Let's do the same with 3 years and 5 years. So this is the longer time frame, and you can see now there are a slightly more number of funds which are in this quadrant, which is positive 3 years return alpha and positive 5 years return alpha. Let's plot them again, which I've done, and you can see Quantax Plan Fund comes up again. Mirai, which was also on that, has come up again. Canada, Robeco, and some of the other funds have also now managed to record positive alpha over a longer time frame. So I've done that. So if you want to drop off at this point, these are the 5 funds that I think are good based on the data we've collected and analyzed from the perspective of alpha, Sharpe ratio, and some of the downside volatility metrics. But obviously, you'll have to choose. My recommendation would be to choose 2 or 3 of these funds and invest in them. But if you want to know which ones to choose from of these 5, then stay on. We're going to do something even more interesting. What we're going to do is we're going to go into so every one of these funds has a page on Valueresearchonline which has all the data. you can go and take a look. And what they have is the portfolio holdings, the composition of what stocks these funds hold. And what we're going to do is we're just going to investigate these 5 different funds to look at what sort of stocks do they hold in their portfolio. And what we're doing here is we've got the link for each of those 5 different funds. We've got the names as well, and we're going into Valueresearchonline in order to fetch this table here, which is the top holdings table. Yeah, and we're going to put them all. We're going to package them together, and this is the table we get. So I'll help you interpret this. So what we have is the name of the stock, the sector, the PE ratio, and the percentage of asset held in that particular stock. So for instance, Quantax Plan Fund has 6% of its holdings in Bharti Airtel. Yeah. So across all of this, if a particular fund does not hold the stock, then it obviously comes up as 0%. But if we put all of them together, all of these 5 funds together, they have 88 different stocks, and this table essentially just summarizes what is the percentage holding in each of these stocks, ranging from 0 to whatever percentage it has. Now we're going to calculate 3 things, which is across. So if you put all of this together, what is the total holding in Bharti Airtel or each of these stocks? And that's what we're going to do. We're just going to sum up these rows and calculate a total here, and that sort of tells us what are the stocks that are that are held the most, or as a composition of asset, what are the stocks that have the highest holding percentage. And what we see is some of the large cap names like HDFC Bank, ICICI, a lot of banks on the top 10, but tech companies as well are on this list. Let's get an average, which is just this divided by 5. What this does is this helps us sort of get a view of what our portfolio will be if we invested in all of these funds equal weighted. So what this tells us is if we sort of take 1,000 rupees and invest in each of these 5 different funds, and our portfolio will have 6% invested in HDFC Bank, 5% invested in Infosys, and so on and so forth. So for an investor looking to just replicate these funds, I mean, if you're not worried about tax saving, if you just want to replicate these funds, then what you could do is potentially just take this average holding and just invest your money in that percentage, and you would have replicated the performance of these 5 different funds. The next measure we'll look at is count, which is to say, which are the stocks that are held by all of them, which are the stocks that are held by 4 of the 5, 3 of the 5, etc. And this table gives us that. So Infosys is clearly held by all of the funds, but TCS, HDFC Bank, and ICICI are nevertheless held by a vast majority of them. So this sort of tells us the popularity metric of each of these different stocks. And the one thing that we could take away from all of this is that because these are all large cap funds, they primarily hold large cap stocks, which I think there's no real secret in terms of how they pick their stocks, I think. So that's how it is. So if you're looking to get exposure to mid cap or small cap funds, then these are probably not the funds of interest for you. But this is how it is. This is because they are large funds, they invest in large cap stocks. Then we're going to do something called principal components analysis. So I did tell you about the 5 funds and how do we choose 2 or 3 from them, and that's what PCA is about. So what PCA does is it takes a table like this, right, which is these are the observations. Let's think in mathematics for a little bit. These are the observations and these are the features, yeah, and this is a matrix. And what principal components analysis does is it takes this matrix and renders it into so this is a 5x88 matrix, and it renders that into a 5x2 matrix so that we can plot it in a 2-dimensional graph. This is often used by data analysts in order to reduce the number of dimensions in data so you can visualize it. I mean, think about it. If you have to plot this data, then you'd need an 88-dimension plane, and it's impossible to even imagine it, let alone plot it there. So what we can do is when we plot it in a 2-dimension, then we can see how similar or dissimilar these funds are, and that's what principal components analysis does. you can think about this as a black box, but there's a bit of mathematics involved in it, where you calculate the covariance matrix, get the eigenvectors and eigenvalues, and then distill it by the top eigenvectors, and these are the top eigenvectors. Let's plot it, because that's where the meaningful result comes in. So what is done, just remember what it has done, it has reduced the 88 feature matrix into a 2-feature matrix, and it has plotted it in a 2-dimension. These features, feature 1 and feature 2, don't necessarily have a meaning, because they're sort of compressed features of those 88, but data points that are close by are similar to each other. That's what the interpretation is. And you can see that these 3 funds are fairly similar from the portfolio holdings perspective. Yeah, that's what we've used. The features are portfolio holdings. Yeah, so the similarity is in terms of those original features, which is portfolio holdings. So you can see that these 3 funds are similar. Quantax Plan is quite different, and the BOA AXA mid-cap fund is also quite different. So if you're just looking to invest in 2 or 3 different funds, then you just have to pick this, and one of these 3, and invest in them in whatever proportion you think is appropriate. So that's where I'd end. If you're just after the question of which ELSS funds to invest in, but for those who are academically interested and want to take it a step further, we can look at similarities between these funds, between all of these funds. Yeah, so there are about 40 different funds, and we can ask the question of how similar or dissimilar are all of these funds compared to each other, and compared to Sensex and Nifty, which is Sensex 30 and Nifty 50. So then you can see whether the original set of mutual funds, the entire universe of ELSS funds, are they replicating just the index, or are they really engaging themselves in stock selection? And that's what this section and the next section is supposed to do. So first we'll plot similarities on the basis of historical returns, which is you have, so again, similar to the previous data, that had 5 rows and 88 columns. This has all of the funds and 28 different return metrics. Yeah, so yearly returns, quarterly returns, monthly returns, weekly returns, etc. So let's just take those return metrics and see if they are similar. Yeah, and that's what it does. So we run a principal components analysis again, and then we plot them again based on 2 features, feature 1 and feature 2, right? And the data isn't really giving away a lot of it, because the points are all over the place. There are no real clusters like we saw before. And I investigated why this is, and this is because some of these funds came into existence in 2010, some of them came into existence in 2013, etc., etc. So when you don't have returns profile data across all of the years, then there is a lot of invalid, unavailable data, and that sort of messes up your principal components analysis or similarity mapping. So what we're going to do is, this one is going to be slightly more upscale, as in it involves a bit more work. So what we're doing here is we're carrying out principal components analysis again on all of those funds, and now based on portfolio components, exactly the same approach we took for those 5 different funds. So what this line of code is going to do is it's going to go and collect data from again value research. So there are about 40 different funds, so it will go into 40 different pages and collect the top portfolio holdings and smash it all together in a table, very similar to what we saw before. This is going to take a little bit of time, so I'm going to pause the video, let it run, and then we'll take the analysis forward from there. Okay, so this is done. So what it has done is it's gone into each of these different ELSS mutual fund schemes pages on value research, and it's picked up the top portfolio holdings from that page, and it's consolidated it all on a single table. I've just displayed the top part of the table, and you can see that on this column you'd have the name of the stock, and on the rest of the columns you'd have the different schemes, and in the end you'd have Nifty 50 and Sensex 30, and the numbers here are the percentage holdings of each of these companies, right? Let's do a similar exercise. Let's calculate the total, average, and count, and what we see is very similar. So so the previous time we just looked at the 5 different funds, and now we look at 42 different schemes. And we see that some of the large cap names still remain as the top holdings from an average perspective, as well as from a count perspective. So 42 of the 42 different schemes have HDFC Bank on them. Now let's run principal components analysis. And this data now shows a trend in that these funds are similar, these funds are similar, this fund here is very different from the others, and then you have a small cluster here, I guess, of different funds, and then you have a cluster here of different funds. Yeah, so you can see there are straight away 1, 2, 3, 4, 5 different clusters. So what I've done next is I've just collected all of this data and put it in a chart. And you can see the clusters that you saw there. So this is a cluster, this is a cluster, this is a cluster, this one is a single one, and these are clusters. So these two dots here are Sensex and Nifty. So this cluster here is trying to mimic the index. Yeah. So rather than, if you're not worried about tax saving, then rather than investing in these funds like Tata India Tax Saving, HDFC Tax Saver, you might as well just invest in an ETF, which at least will not cost you money. These funds are different. So the ones in yellow color are the ones that we've already investigated. So the 5 funds which we shortlisted. So you can see 4 of those funds are here on this. And this is the Quantax Plan Fund, which is quite different from the others. That one's the Axis Long-Term Fund, and these 2 are Aditya Birla Sun Life. I mean, being different is not necessarily good, but it sort of tells you, if you're picking a few of these funds, then it would make sense to pick, one from this bucket, one from this bucket, maybe even one from this bucket, and one from this bucket or so. So that's what similarity mapping does to us. Finally, the most important thing, fees. So let's look at how the fees profile is distributed. So a vast majority of the funds charge between about 1 to 1.5%, but there are funds which charge 2.5%. There are funds which charge 0.5%. But this sort of gives you a range. So when you're picking a fund, important to take a look at the fees, and you can see how they're distributed. Next, what we do next is plot the expense ratio against Sharpe ratio. So what this will tell us is, are these funds actually earning their worth? Yeah. So if they're, so these funds are the most expensive, right? This is the y-axis is the expense ratio. So the further up on this y-axis, the more expensive it is, and further right on the x-axis, the higher the Sharpe ratio. These are good funds because their expense ratio is less than 1.5. The charge, or these are good value for money fund, right? And the Sharpe ratio is over 0.2. And these are terrible funds in that they're very expensive, and the Sharpe ratio is negative and the least. So let's just investigate. So these are the good funds. So the ones in the blue box are here. So these 2 funds we already looked at, the BOA AXA and the Canada Robeco fund. We've already seen, and these are the bad funds which are listed here. So in bad funds meaning that high expense ratios and low Sharpe ratio. So that's it. So that hopefully gives you an idea about all these funds, the different the different metrics involved in analyzing them, and the different methodologies and the risk metrics that you should typically be considering before investing in some of these funds. If you enjoyed this video, please do like it and share it with your friends. And if you have any questions, please send me an email or write a comment below. Thank you, and bye bye.